Thanks so much for joining us today. I'm Angie Winton, your host, and on behalf of my fellow partners, I wish you a very warm welcome to this pre-election budget analysis. The budget that was handed down by Treasurer Josh Frydenberg Tuesday night showcased a pretty resilient economy, which is roaring along in some respects. Commodity prices remain robust and once again propping up the budget's bottom line. Unemployment is at 4-decade lows, but there is over $1 trillion of post-COVID debt, a $78 billion deficit. With inflation over 4%, cost of living pressures are a major challenge for the Morrison government. The problems are not easily solved. Energy supply and cost is also a global concern now, and the government went some way of dealing with this issue by halving the fuel excise in an effort to address the spiking cost of petrol. No doubt clean energy and climate will be on election issues. There's massive spending in this budget for regional Australia for infrastructure development, while defence spending has been boosted to meet the rising geopolitical tensions across the world. So there's a lot to unpack, particularly in terms of what this means for Australian business. We've assembled a cracking lineup of Mazars specialists to bring you expert, straight-talking analysis on what this budget means for you and your business. Right now, we'll hear from Evan Beisel, a tax partner in our Melbourne office. Evan's key areas of expertise include advising on complex tax matters for high net worth families, trusts and deceased estates, as well as international tax and business structuring. Today, Evan will take us through the tax changes impacting individuals, including superannuation measures.
Well, thanks, Angie. It's really great to be able to be with you today. I'm going to be taking us through some of the key tax changes in the budget affecting individuals. I'll also cover some of the superannuation changes in the budget, as well as a few relevant non-tax measures of note. Now, overall, there wasn't a lot in this budget in the way of tax changes. This was a fairly safe budget that didn't bring in any major tax reform and really just had a few minor sweeteners to try and sway the electorate in the government's favour. So let's step through the changes that were announced. So what has been announced in the way of tax measures that affect individuals? Well, the main headline in this area, in this budget, is the increase to the low and middle income tax offset. And this is an increase of $420 for every individual with an income level of up to $126,000 that's currently eligible for that offset. So just to refresh, this is an existing tax offset that's been around for a few years now that currently offers up to $1,080 of tax offset. And so with this additional $420, the maximum offset available will be $1,500. Now, just for some context, what these tax offsets really do is a targeted tax reduction. They aim to reduce the overall tax paid by people at certain income levels. And so what this is intended to be is targeted tax relief. But interestingly, the way the $1,080 offset works is it does phase out. So between incomes of $90,000 and $126,000, that offset slowly reduces it to zero. But with this increase, there's no phasing out of that additional $420. Once you get the whole amount up to $126,000 of taxable income, and then you get none, which probably won't affect many people. For most people, they will either qualify or they won't. But it does show, in my mind, a measure that's been hastily drafted and doesn't necessarily have the best underlying policy basis. So the next one to talk about is the deductibility of COVID-19 tests. Now, it's actually broader than the rapid test, but in practice, it's the deductibility of the rapid test that I think is going to matter for most people. And that's where you have a COVID-19 test that you are required to take either to attend work or to stay at a place of work. And it's a pretty narrow deduction. And so, for example, if your employer says that you must take a rapid antigen test before presenting to your workplace, then that would qualify for a deduction. But if, say, you're, a very careful individual and you're really concerned about maybe infecting your colleagues, but there's no requirement for you to do so, but you choose to take a rapid test each day before you go to work, that wouldn't be covered by this deduction. So probably, I think, of fairly limited scope, but good nonetheless to have that deductibility available. Finally, as Angie mentioned earlier on, the halving of the fuel excise. Now, this is not a tax that is levied on individuals, but it directly affects everyone's hip pocket. So that fuel excise currently, or what was 44 cents per litre, is to be halved, and that is directly baked into the fuel prices that you and I pay at the petrol station. So really good news for consumers' hip pockets, but only for 6 months. I think it's also worth talking about what wasn't in this budget. And there are a couple of things missing I just wanted to mention. The first is an extension to the low and middle income tax offset. Now, even with that additional $420, this offset ends this financial year. And there's an expansion of the low income tax offset, but there's a group of middle income earners who will no longer get an equivalent tax offset. And for those middle income earners, that means this offset goes away from 1 July. Now, remembering that these kind of tax offsets are really a targeted tax cut, well, when that targeted tax cut is taken away again, well, that's really a targeted tax increase. So this, without an extension to the low and middle income tax offset, we effectively have a tax increase for middle income earners effective from 1 July this year. Also, the stage 3 tax cuts were not brought forward. Now, some commentators were suggesting this might be an election sweetener, that the government might bring forward the tax cuts that have already been legislated to commence from 1 July 2024, but that wasn't included in the budget. So we still have a couple of years to wait before those further tax cuts come through. Briefly, I think it's worth just refreshing what those tax cuts look like. So on the left-hand 2 columns there, we've got the current income tax rates, and on the right we have the stage 3 tax cuts from 1 July 2024. And you can see the main thing there is reducing from 5 tax bands to 4, and the really important part of those tax cuts is the flat 30% rate from $45,000 all the way up to $200,000. And to put some meaning on that, just to share a table that I've shared previously, this shows the actual dollars tax savings at different income levels. So taxable income of $100,000, that's just under $1,400 of tax saving under the stage 3 tax cuts, whereas at a taxable income of $200,000, that's just over $9,000 in tax saving. So you can see these stage 3 tax cuts are really weighted towards higher income earners in their benefit. Now, briefly, a couple of non-tax measures that affect individuals that I thought was worth mentioning. The first is the $250 cost of living payment. This is a cash payment to people who won't necessarily benefit from the increase to the low and middle income tax offset because they are low income earners on some sort of welfare payment. So there's a list of payments of people that will qualify for that $250 cost of living payment, and it includes things like the age pension, New Start allowance, disability pension, and a range of other payments, welfare payments of that nature. Secondly, I wanted to briefly mention the paid parental leave changes. Now, currently we have 18 weeks that's usually available to the mother and another 2 weeks available to a partner. And this proposal, or this announcement, is that will be combined into a 20-week sort of pool of paid parental leave that can be divided between both parents as desired by the parents. So that may be beneficial for some people. For others, it may leave them, pretty much the same as the current arrangements. Finally, on this one, the home guarantee scheme. Now, that is a government-backed scheme to help first home buyers get into homes with a low deposit. So if you can buy a home as a first home buyer with only a 5% deposit, and instead of having to pay lender's mortgage insurance, the government is guaranteeing that loan. And so this increases that home guarantee scheme so that more people can take advantage of that benefit. Moving on to superannuation, there was really only one announcement in the budget that affects superannuation, and that was to extend the temporary reduction in minimum drawdown rates for people who have an account-based pension or a similar type pension arrangement within their superannuation. This was introduced back in 2020, initially for a 2-year period and then extended once already, and with the intention that it allowed people who are drawing superannuation pensions to have more flexibility about drawing a bit less from their fund, say if it was affected or if the asset values in their fund were affected by various markets and economic situations that have existed through the COVID period. So that's set to continue for another year to 30 June 2023, which really just gives more flexibility to people in that category. They can still choose to draw more, but they can have that minimum reduced if they choose. In terms of previous superannuation announcements that are still pending, we had an announcement in last year's budget to relax the residency requirements for self-managed super funds by extending the central control and management safe harbour test from 2 to 5 years and removing the active member test. This has not yet been legislated, so we're still waiting for that. And the same for the legacy pension amnesty, which is intended to allow people who were had certain legacy pension products in their superannuation to be able to have a 2-year period to get out of those products into a more modern, say, account-based pension. So that also hasn't yet been legislated. The third one is the increase in the super guarantee rate. This has been legislated. We might have expected a freeze in this rate, particularly given the pressures on households and not necessarily a commensurate increase in wages, but that was not present. So as it stands, that superannuation guarantee rate will increase from the current rate of 10% to 10.5% from 1 July 2022. So that brings my section to an end. I'll hand back to Angie for the rest of the presentation.
Thanks so much, Evan. Well, I'm now pleased to introduce Gabrielle Cleary, who leads our Sydney Tax Consulting Division. Gabrielle has extensive experience in the areas of corporate restructures, mergers and acquisitions, divestments and global mobility. Gabrielle will take us through the measures in the budget for business. Thanks, Gabrielle.
Thank you, Ange. From a business and taxation perspective, this budget has been referred to as a friendly budget. However, there were very limited announced changes for businesses. There were no new taxes and no new restrictions imposed. Instead, small businesses were offered some new benefits, and there were some extensions to previously announced measures, which are focused on providing growth and innovation. I'll provide a rundown of some of the key announcements which were made for businesses. First, we'll look at the new incentives and measures for small and medium businesses. There are 3 new measures announced for small and medium businesses, being the Skills and Training Boost, the Technology Investment Boost, and the variation in the GDP uplift factor. I'll now go through each of these separately. The first measure is the Skills and Training Boost, which was announced to support small businesses to train and upskill their employees. In accordance with the measure, small and medium businesses with aggregated annual turnover of less than $50 million will be entitled to deduct an additional 20% of the cost of expenditure incurred on external training courses provided to their employees. In other words, businesses will be eligible for 120% deduction for the cost of these training courses. In this manner, if an eligible business incurs $10,000 of expenditure on a training course, the business will be entitled to a deduction for $12,000. In order to be able to claim this deduction, the external training course must be provided to employees in Australia or online and must be delivered by entities registered in Australia. This boost is expected to increase demand for Australian-based training businesses. Note that the additional deduction will not be available for any in-house training, on-the-job training, or expenditure on external training courses for persons other than employees. The boost is intended to apply to all eligible expenditure incurred from budget night on 29th of March 2022 until 30 June 2024. There will be no cap on the training expenditure which is eligible for the boost. Note that in claiming the 20% boost for eligible expenditure incurred up to 30 June 2022, the deduction will be deferred until the 2022-23 income year. For all other expenditure which is incurred from 1st of July 2022 until 30 June, the deduction will be included in the same year in which the expenditure is incurred. The next measure is of a similar vein to the skills and training boost. It is a technology investment boost proposed to support digital adoption by small businesses. In accordance with this measure, both small and medium businesses with aggregated annual turnover of less than $50 million will be able to claim a deduction of an additional 20% of the cost incurred on business expenses and depreciating assets that support their digital adoption. The technology investment in Boost is only available for expenditure incurred from 29th of March 2022 to 30 June 2023. At this stage, the full details of what the relevant expenditure that this boost will apply to is still to be provided. The only details provided to date is that it will include costs associated with the acquisition of portable payment devices, cybersecurity systems, and subscriptions to cloud-based services. While we will need to wait on the legislation to determine the full extent of the boost, the description of the items included appears to indicate that the 20% boost will not apply to the acquisition of standard computers for everyday use. Rather, it appears that the intention of the provision is to apply for more specialised digital services. Unlike the skills and training boost, the technology investment boost will be subject to an annual cap of $100,000 of expenditure for a qualifying income year. That is, the maximum boost claimable for a year of expenditure is $20,000 or a total of $40,000 over the 2 years. To illustrate, if a business incurs $80,000 of expenditure in a year on digital adoption services, the full deduction available will be $96,000. This will provide a deduction of $80,000 of the cost, plus the additional boost deduction of $16,000. However, if the expenditure incurred during the year is $150,000, the boost will be limited to just $20,000. Similar to the skills and training boost, the 20% boost will, for eligible expenditure incurred up to 30 June 2022, will be claimed in the tax return for the following income year. The boost for the expenditure incurred between 1st of July 2022 and 30 June 2023 will be included in the income year in which the expenditure is incurred. As a result, for businesses without a substituted accounting period, the full amount of the boost is expected to be included in the 2022-23 income year, with a maximum claim of $40,000. The next measure is an adjustment to the GDP uplift factor for both PAYG instalments and the GST instalments. The GDP uplift factor will be fixed at 2% for the 2022-23 income year. This uplift factor is lower than the 10% that would have applied under the statutory formula. The 2% GDP uplift will apply to small and medium enterprises eligible to use the relevant instalment methods. This is for businesses with less than $10 million aggregated turnover for GST instalments and for businesses with less than $50 million annual aggregated turnover for the PAYG instalments. This change is not considered to be significant as businesses have always had the ability to vary their own instalments down if they believe the original instalment would have resulted in overpayment. However, the measure makes the reduction automatic for all eligible parties without the risk of penalties. It may even provide a cash flow advantage for others. This reduction is only available for instalments that relate to the 2022-23 income year and that fall due after the enabling legislation receives assent. I will now move to the key announcements for all businesses. Most of these measures are merely extensions of the previously announced tax measures. Most of the original measures were announced in last year's budgets, providing a feeling of déjà vu. The 4 extended business measures which were announced are an extension to last year's patent box concessions, a change to the regulatory requirements for greater access to employee share schemes, additional exemptions for the COVID-19 business grants, and an extension of the apprenticeship wage subsidy. We'll look at each of these measures separately. The first measure relates to an extension of the patent box regime. This was announced in last year's budget to cover patents, principally in a broad range of sectors. As you may recall, the patent box regime was originally proposed to encourage investment in Australian medical and biotechnology innovation. The original regime, which is still proposed to apply from 1st of July 2022, relates to income derived from the commercialisation of patents that were applied for from 11 May 2021 and were granted by IP Australia. Such income would be taxed at an effective concessional corporate rate of 17%, rather than the applicable corporate rates of 25% for base rate entities and 30% for all other entities. This essentially provides a tax concession of up to 13%. The measures are not currently law as the bill is still before Parliament. The original scheme provided only for patents that had been applied for on or after 11 May 2021. This has now been extended to allow patents granted or issued after 11 May 2021 to also be eligible for the regime. And the original scheme will also be extended to recognise patents granted under the US and European regimes, as well as those granted by IP Australia. To further extend the patent box provisions, the government has announced the regime will be extended to other sectors to cover both the agricultural sector and low emissions technology innovations. In the case of agricultural patents, the regime is proposed to apply to corporate taxpayers that commercialise their eligible patents linked to certain listed agricultural and veterinary chemical products. It will apply to patents granted or issued after 29 March 2022 for income years starting on or after 1 July 2023. The same dates will apply to low emission technologies as identified by the government. The government proposes to consult with industry on the detailed design of the patent box expansion. The extension of the patent box regime to a broader range of eligible sectors and innovations, together with the tax savings of 13%, certainly provides a welcome boost to the commercialisation of innovation in Australia. The announced employee share scheme measures are not changes to the taxation treatment, but rather apply to increase and extend the potential for employee ownership participation in London-listed companies. They seek to remove some of the red tape regulatory requirements associated with participation in the scheme, particularly with unlisted companies. In accordance with the provisions, where unlisted companies offer employee share schemes to their employees, the participants will be able to invest up to $30,000 per participant per year, accruable for unexercised options for up to 5 years, plus 70% of any dividends and cash bonuses, or an unlimited amount if it would allow the employee to immediately take advantage of a planned sale or listing of the company to sell their purchase interests at a profit. In addition, the regulatory requirements for making offers for independent contractors will be removed, where the contractor is not required to pay anything to acquire the interests. Note that employees and contractors will still be subject to the same taxation implications from taking up interest in these employee share schemes. In other measures, the government has announced that it is extending the list of state and territory COVID-19 business grants, which will be treated as non-assessable, non-exempt income for tax purposes until 30 June 2022. The relevant grant must be listed to be treated as non-assessable, non-exempt income. The other measure announces the boosting apprenticeship commencements wage subsidy will be extended to 30 June 2022 to support businesses and group training organisations to take on new apprentices and trainees. Under the program, eligible businesses will be reimbursed up to 50% of an apprentice's or trainee's wages of up to $7,000 per quarter for 12 months. It is hoped that the measure will provide additional apprenticeships and trainees. I will just quickly mention three other tax measures which everyone should be aware of. As mentioned earlier, it was confirmed that businesses will receive an FBT exemption for the provision of work-related COVID tests. A logical position, given the Prime Minister's statements in earlier press conferences this year. The government has announced that the ATO Tax Avoidance Task Force has been extended to 30 June 2025. The ATO has been provided with a renewed period of funding to continue tax assurance and compliance activities targeted at multinational enterprises, large public and private businesses, and their associated individuals. While the ATO has been very quiet and relaxed with audits and compliance over the last 2 years during COVID, there has been a very noticeable shift in audit and review activity over the last few months. As you're probably aware, the ATO are pushing hard with various actions, including the top 500 and the next 5,000 assurance reviews, ensuring tax governance, risk management, and addressing the taxation treatment of trusts. Jamie will address the increased focus on trusts shortly. And finally, there is a concessional treatment will apply from 1st of July 2022 for primary producers selling Australian carbon credit units and biodiversity certificates. Proceeds from the sale of Australian carbon credit units and biodiversity certificates generated from on-farm activities will be treated as primary production income, providing access to existing income tax averaging arrangements and the Farm Management Deposit Scheme. This summarises the tax changes impacting businesses announced in the budget. A rather quiet year for businesses with very little substantive changes. However, there are certainly incentives provided for growth, training and innovation, especially for the small businesses. I'll now pass back to you, Angie. Thank you.
Thanks so much, Gabrielle. So now to round out our coverage of Budget Insights, I'd like to introduce Jamie Towers, who leads our Queensland tax consulting practice. Jamie's known for his skill in taking the complexity out of taxation, explaining the intricate tax issues and actions to both Australian and international clients in a straightforward manner. Jamie will now take this opportunity to highlight some other timely considerations for business owners, including tax planning actions. Thank you, Jamie.
Great, thank you, Angie. First off, before I begin talking about other measures, I'm pleased to announce that the government yesterday actually passed a lot of these measures we've been talking about through Parliament, through both houses of Parliament. So it's just waiting royal assent. So the deductions for RAT tests, the employee share scheme measures, the GDP measures, the Limito tax offset increase, the cost of living, the $250, and also the fuel excise. So that's all passed, and as soon as the Governor-General gives it the tick, that will be law. So we can look forward to those measures. So I'll briefly talk about some measures that were passed over the last few years under the COVID stimulus that continue into the next year. So these rules are still with us, so businesses can actually take advantage of those rules into the next couple of years. So the first one is the temporary full expensing of assets. Now, originally it was a limited incentive, but that was extended until 30th of June 2023. And that's the measure where a business can purchase an asset and get a 100% upfront tax deduction for the cost of that asset. So again, government encouraging businesses to spend to help stimulate the economy. And I think part of the reason why we haven't seen as much in the way of stimulus in this year's budget is because we do have this continuation of stimulus from the last couple of years. So as we're approaching, I guess, 30 June, and you're thinking about tax planning, if you are looking at purchasing assets, consider bringing that forward so that you can claim that tax deduction in the year of purchase. Now, the next stimulus, which was announced a couple of years ago, are the loss carryback rules. Now, these apply to companies and they apply for years up to 30th of June 2023. Now, the rules apply if you've made a loss in the last couple of years, but you'd paid tax in an earlier year, back to 2019. So the way it operates is, let's say you've made a $50,000 loss in this financial year and you'd made $100,000 of profit in the 2019 or a later year. You can take that loss, carry it back to the earlier year and acts as a tax deduction. And you've already paid tax in the earlier year, so you can actually get a real tax refund based on the loss that you've made this year. So it's a good way to keep cash in the economy to enable businesses to keep going and keep spending. So those rules are extended until the 30th of June 2023, and that's already law. And probably the other major change that was legislated in prior years is the extension of a small business definition. Now, the small business definitions have changed a lot over the years, and there's still a few variants, but these are the ones talking about the small business measures. Now, these allow for things like simplified trading stock accounting, prepayment rules, simplified depreciation rules when the temporary full expensing of assets has finished. And importantly, for a lot of our clients, certainly as today is the end of the FBT year, for small businesses, they don't pay any FBT on car parking. Now, the definition of a small business has been extended from a $10 million revenue or turnover to $50 million of turnover. So a lot more businesses than previously are able to take advantage of those simplified tax accounting measures. So a good move in my view. The next thing I'd like to talk about is of quite concern to tax agents and also to trustees of trusts generally. And this is a measure by the ATO in relation to what they call reimbursement agreements. So a little while ago, the ATO issued a draft tax ruling, so 2022 draft number 1, a draft practical guidance statement, 2022 D1, and a taxpayer alert. So they were all issued at the same time in relation to what they call reimbursement agreements. Now, a reimbursement agreement has been in the law for over 40 or around 40 years. And it is an anti-avoidance rule, and unfortunately, being an anti-avoidance rule, the ATO has an unlimited period of review. So it's no longer a 4-year period, it's an unlimited period of review. Now, the focus of these reimbursement agreements is if a trustee makes a beneficiary entitled to income, but the money doesn't go to that beneficiary, it goes to someone else, and the ATO believes there's an arrangement, and there is the whole arrangement is to reduce tax on that amount of income, then the ATO believes that that's really tax avoidance and they're going to penalise you. Now, for the last 40 years, there's been virtually no ATO announcements in relation to this. There's only been very few tax cases in relation to this. And overall, the tax profession was quite comfortable in relation to this anti-avoidance law because there is an exception to the application of the law where the reimbursement agreement occurred for ordinary family or commercial dealings. And again, it's not defined, so it then comes down to its ordinary meaning. And there's been a little bit of case law around it, but very little. But I guess the tax profession was fairly comfortable when you're dealing with family trusts that if you're distributing amongst family members, it's an ordinary family dealing, so it shouldn't be of concern. But the ATO has changed our thinking on this. Now, when they release these, the tax ruling, the guidance and the taxpayer alert, they've taken a different view in relation to these reimbursement agreements and indeed what is considered an ordinary family dealing. And I'll illustrate on this slide what we're talking about. So we've got a trust and mum and dad control or either are the trustees of the trust or control the trustee. And they make Johnny, who's an adult beneficiary, presently entitled to $180,000 of trust income. So that means that he can call on the trustee at any time to pay him that money, and he's required to pay tax on his proportionate share of the trust's income. Now, we'll assume that mum and dad are already on the top marginal tax rate, so it's not tax effective to distribute any more income to mum and dad. So the trust has made Johnny entitled to this income, but he never receives any of the money. The cash is either loaned or just taken by mum and dad who control the trust, and yeah, Johnny never receives it. Mum and dad might contribute towards Johnny's tax bill, but otherwise he's not calling on the income. Now, the ATO think that there might be something a bit funny about this arrangement. And it's very subject to facts and circumstances, but where the ATO believe that that the only reason that Johnny's become entitled to that $180,000 of income is so that mum and dad can reduce the overall trust tax bill, then they say that Section 100A can apply. Now, if Section 100A applies, what happens is Johnny is deemed not to be entitled to any of that income, so he's not taxed on that, so he doesn't get the marginal tax rates, but instead the trustee of the trust is taxed on that income at top marginal rate on the full $180,000. So not a good tax position to be in. So you're effectively paying nearly $90,000 of tax rather than about $50,000 of tax. Now, the taxpayer, the tax ruling takes you through various scenarios what the ATO is concerned about, and it also goes to talk about what the ATO believes is an ordinary family dealing or what is not an ordinary family dealing. What the ATO is saying is just because it's commonplace and a lot of people do distribute money around family members, they're saying just because it's commonplace does not mean it's ordinary. What the ATO believe is, well, just because you're distributing to family members, if there is a reason to avoid tax as part of that distribution, that's not necessarily an ordinary family dealing. Whereas previously we were quite comfortable with that particular view. Now the practical compliance guide that the ATO has released looks at different levels of risk around these areas. So there's a green, blue and red layers of risk. And there are various examples that's set out in the practical compliance guide as to whether the ATO will dedicate active resources to look at your particular trust. And then the taxpayer alert in particular looks at some scenarios similar to what we've described here, but where the money is paid back to mum and dad, and the reason that it's paid back to mum and dad is to reimburse them for Johnny's schooling when he was a minor beneficiary. Now the ATO says, well, that shouldn't be correct. Johnny could never have made that decision to reimburse that money while he was a minor, so that smacks of tax avoidance. So the ATO are very, very concerned about that. So the tax profession's a bit concerned about these ATO views, and some of the views that they've put forward in this draft ruling also actually go against some of the case law. There was a recent case last year which is on appeal to the full federal court, but the ATO seemed to have disregarded that case that was found in the favour of the taxpayer in relation to these type issues. Now, the rulings are only draft, so draft ruling, draft guidance, but a full taxpayer alert. But it shows you the way that the ATO is looking, and of that, I think it was $630 million that the government has given to the ATO over the next couple of years. You can bet there will be a lot of audit work focused on trusts. So what Mazars tax advisors are particularly stressing to their clients is if you've got a family trust, you do need to spend some time reviewing your prior arrangements and speaking with your Mazars advisors to see whether or not it falls within any of the larger levels on the compliance guidance and what you can do about it. But then on a look forward basis, I think trustees do need to spend a lot more time pre-30 June deciding who is going to receive trust distributions. So you do need to do a lot more tax planning, work out what the income of the trust is going to be and who is best to receive the income so as not to upset what the ATO is concerned about. So I'll now move on to some, I guess, election wish lists and what didn't happen in the budget. So as Evan and Gabrielle have mentioned, there was no real tax reform, which is always wishful thinking in an election year. So election year budgets generally are nice to voters and not a lot of change. There has been no indexation of tax bands, although we are having the tax changes occurring in 2024. We've had no change in the key tax reporting thresholds. So for example, we've had the small business CGT measures around for many, many years with the same thresholds, $2 million of revenue and $6 million of assets. Now these haven't been indexed and they've been around for many, many years. The ATO has just increased the definition of a small business for tax accounting from 10 million to 50 million, yet the small business CGT measures remains fixed. So it doesn't quite seem right. So we were hoping things might change, but not yet. We've also had no tax incentives for businesses to decarbonise the economy. So last year, the government committed to a net zero carbon base by 2050, but there's nothing from a tax perspective to encourage businesses to do that. Yes, there are some funds available for potential grants in the future, but they are one-offs and you have to go through a grant process. Whereas tax incentives are very broad-ranging and can affect a lot more businesses. So there's nothing there. Perhaps we might wait to see that in the election promises, but nothing in the budget. And similarly, from an FBT perspective, The fringe benefits tax still incentivises the use of cars rather than public transport or active transport. Yet we're seeing other countries, even the US, grant incentives for employers to reimburse employees' public transport. Europe, some countries in Europe have been incentivising active transport like bicycles. We haven't seen anything like that yet so far. So it's on the wish list. From an international perspective, again, we've seen no change in key reporting thresholds. So for companies with international related party dealings, if it's more than $2 million, they have to report. Now that threshold has been in place for at least 20 years. Thin capitalisation rules, reporting threshold for interest of $2 million, again in place for many, many years, not indexed. There's a hope that the government might increase those to reduce reporting and red tape, but they haven't. Now in the 2020 budget, the government announced changes to the definition of a corporate tax resident, but we're still waiting for any legislation. In the 2021 budget, so last year, the government announced changes to the definition of an individual tax resident. Now, the government has been consulting on this since at least 2016 when they asked the Board of Taxation to provide a report. It took them from that report right the way to 2021 to announce it, yet we've still seen no legislation. So that is disappointing. Now, we've seen significant announcements by the OECD on international tax reform over the last year. Nothing has been mentioned in the budget. So for me, that is quite disappointing. And for Australia to remain internationally competitive, we do need key tax reform. So let's hope we've got an election year. Some of these things might get announced as part of some of the election announcements. So that's it from my perspective. I'll hand over to Angie to wrap things up. Thank you.
Thank you, Jamie, Gabrielle and Evan for your insights today. And thank you for tuning into the Mazars 2023 Federal Budget Analysis. It has been our pleasure having your company today. Please reach out to any of our presenters or your usual Mazars contact if we can be of further assistance. Have a great day.